Hello and welcome to this latest weekly market recap for the week ending August 29th, 2025. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com. It's a pleasure to be with all of you again today. Well, August is over. We ended last week, got a pretty decent GDP report, saw GDP a little higher than expected. That gave the economy a little bit of a boost. But we did see one of the preferred gauges that the Fed watches in terms of inflation, the PCE index, did rise. It was as expected, but it did rise last week. So of course the Fed's got a little bit of, strength in the GDP, a little bit higher inflation number, but still trying to reconcile that with the very, very weak jobs report that came out last month, which showed not only the jobs in July were very slight at 73,000, but if you recall, the two prior months, May and June, were both revised substantially lower by more than 250,000 jobs combined. And so both of those readings back in May and June came in just barely above zero. So the Fed's got this, balancing act that they're trying to figure out. Do they cut rates now, given the fact that jobs have shown 3 months in a row of weakness? Or not really weakness, but a slowdown? Or do they focus more on, do they do what they've been doing, which is focus more on inflation, paying attention maybe to the fact that inflation numbers have gone up a little bit recently? Futures right now in the bond market are predicting about a 90% chance that the Fed is going to cut rates at its two-day meeting in September by a quarter basis point. That's what I'm expecting. Be surprised if they change it, but we will get a little bit more data out over the next couple of weeks. And I'm sure the Fed will be watching that pretty closely. So we'll have to kind of, take that, as we get it, take that information in as we get it. We do have another big jobs report coming up this Friday, and I think that's going to be a very significant and very impactful report, not only for the stock market in the short term, but also for the Fed in terms of the decision that they're going to make. If jobs come in pretty weak again, even if they're positive, but not too positive, I think many of the Fed officials are going to look at that as a continuing sign that the economy is weakening and they need to take action currently rather than waiting any longer. So anyhow, that's how we're going to start the week. That's how we're going to start the month of September, which historically is not a good month. I'm about to talk about some of the reasons why, some of the things you need to be thinking about as we head into the next month and into the last 4 months of the year. So with that, let's go ahead and take a look at the action from last week. And you'll see that the Russell 2000, the IWM, which tends to do better during rate cut period, or at least when the market is expecting rate cuts. This is a group that's a little bit more rate sensitive. And the group did outperform. It was the only major index to gain last week. It rose a little bit more than 0.1%. Everything else was down. And kind of surprising, maybe, the transportation area, which typically does well when you're expecting rate cuts, and did so for a little while, has kind of taken a back seat, not really performing nearly as well as some of the other rate sensitive areas. And you can see last week dropping 1.2% and kind of, struggling behind all the other major indices. I think that's notable because I think that it's a little bit of a sign that indicates or confirms that we are having economic weakness, or we're at least staring at economic weakness ahead. But the flip side of the coin is normally that means rate cuts and money rotating into transport. So anyway, mixed signal with transports for sure. I'm not quite sure what to make of that. I would expect with upcoming rate cuts to see transportation doing better. That's what we saw for a few weeks, where all of a sudden transportation was leading the other major indices. But we've seen that kind of change over the last couple of weeks, and certainly digress a little bit last week. Looking over the last week at the sectors: healthcare, consumer staples, energy, real estate, financials, materials. These are all areas that reek to me of more value oriented versus growth oriented. And then when you look down toward the bottom and you see technology, consumer discretionary, industrials, you start thinking more of aggressive growth type names. And you can see they didn't do nearly as well last week. So certainly last week there was a shift, and we're going to talk about that a lot during this show today. But a lot of money is rotating into more defensive areas, more value-oriented areas. And, the dilemma here is that we typically see that this time of the year. Late August into September and early October does tend to favor much more defensive-oriented areas of the market. That's the normal. So normally when we see money rotating as the market's trying to put in new highs, we see that money rotating into more defensive, more value-oriented areas. It's a warning sign. But how much of it is a warning sign and how much of it is just due to normal seasonal factors? That's going to be something we have to kind of watch as we go forward. And keep in mind, the most important signal that we have is price action. So even when prices are going up and we're getting these warning signs, we don't really start to get bearish until we see the breakdowns, until we see price starting to do what it looks like it could do based on all these other secondary signals that we look at. Anyhow, hopefully that makes sense. I wanted to point out, though, on Friday in particular, and this was after the PCE report came out on Friday morning, take a look at what happened to discretionary stocks. Consumer discretionary took a really big hit. And when you look at consumer staples, which had been very weak earlier in the week, they actually rose on Friday. So we saw a bit of shift in that sentiment on Friday. And one of the things I'm going to be looking at going into next week and throughout September is whether or not that shift that we saw on Friday continues. I suspect, based on seasonal factors, that we're going to see that continue at least to some degree. But do we see it to the extent where we start to see breakdowns in the major indices? That is maybe a little bit of a different story. Anyhow, S&P 500, speaking of major indices, we actually closed on the S&P 500 above 6,500 on Thursday for the first time in history. So there's your good news for last week. We had never closed above 6,500. We did it on Thursday, and then we saw a lot of weakness on Friday. And again, is that the start of something? Is it the start of a bear market? It could be. I'm going to show you a couple interesting facts later. Is it just the start of normal weakness in September? Because that is what we typically experience in September is weakness. Market, it's the only calendar month where the S&P 500 has gone down more often than it's gone up. And that goes back all the way to 1950. All the other 11 calendar months have been higher more often than they've been lower. September's the exception. So what I've been telling members at Earnings Beats is lower your bar of expectations for the market. This is not the time to be a hero. Market might go higher. It does go up in September sometimes. We might set new highs, but what you need to understand is that the risks are elevated right now. And that's the way I'm approaching the market. I'm doing it with much more cash. I'm doing it with much more of a look into value-oriented stocks, maybe trading more of those and less of the aggressive growth, at least until we start to see some really key support levels come into play in some of those growth stocks. So that's something to think about. Let me go back here because I wanted to show you in the month of August. Look at this is the QQQ relative to the spider. Normally, I like to see this going higher to support and give me the impression anyway that the S&P 500 advance is sustainable. When I start seeing growth moving down, that usually means technology weakening. It's really hard for the S&P 500 to sustain a move to the upside if its largest component, technology, which represents 33% of the S&P 500, if that group is underperforming, it's very difficult for the S&P to do much to the upside. And that is the case. We started to see that here over the past few weeks, money rotating away from some of these higher growth areas. Consumer discretionary versus staples has been very bullish. It's had a great month of August. Turned lower, like I talked about on Friday, but overall it's been doing very well. So a little bit of a mixed signal there. Looking at large cap growth versus large cap value, we're rolling over. And I talk about the past, that's always a warning sign for me when we're seeing the S&P 500 move up to new highs, which we saw on Thursday, first time ever closing above 6,500. And we're doing so with money rotating away from growth. So that's always a warning sign. You should always be thinking, at least having some kind of, cautiousness. Like I said, lowering the bar of expectations. I think until it starts to right itself, which might not be until sometime later in the fourth quarter, because again, this is more of a tendency as we head toward the end of the year. And I've got some seasonal charts to show you to kind of support all that. Here's large cap growth versus large cap value, just another way to look at it versus the IWF, IWD. But again, rolling over, here's mid cap growth versus mid cap value, going down almost the entire month of August. Small cap growth versus small cap value, again, going down almost the entire month of August, or it was going down the entire month of August. So, that's the backdrop. That's not great action. So I don't want to spin this. I mean, I'm bullish, but I'm cautious in the near term. I think ultimately we're going back up to all-time highs in the fourth quarter, but I don't know exactly what September holds in store for us. And so that's where I'm sitting right now. Now, looking at the S&P 500, this is a seasonality chart. And this goes back over the last 13 years. If you recall, 2013, the S&P 500 finally cleared the tops from 2000, 2007. That to me was confirmation that the secular bull market had begun. That was in 2013. So what I'm doing here is I'm just going back to 2013, which is only looking at this period where we've been in this secular bull market. And I want you to look at the history of all the calendar months and take a look at September. It's the only month that has gone up less than 50% of the time, even during a secular bull market. So 58% of Septembers over the last 13 years have been lower. The average during the month is minus 1.5%. If you look across the bottom, let me kind of make this a little bigger so everybody can see this. If you look across the bottom here, September is the only month that has average losses, and it's a minus 1.5%. So you might say, well, I'm okay, holding minus 1.5%. That's the average. There have been many years when it's been worse. So if we go back 13 years, what you can do is just drag this to 1 year and you can take a look year by year. So last year, September was 2%. Year before that, it dropped 4.9. Year before that, 9.3, almost a correction. 4.8, minus 4.8, minus 3.9. So last year we were up 2%. The 4 years prior, we had decent sized losses each of the 4 years. Then as you go back further, September was up 1.7, 0.4 higher, 1.9 higher, minus 0.1, minus 2.6, minus 1.6, up 3%. That was back in year 2013. So that was the first year of the secular bull market when it was confirmed. And that was the best September we had. But looking at all those numbers, even if you sit on the sideline, history tells us you're probably not going to lose too much buying power, because September, rarely do we just see the market take off. Just normally doesn't happen that way. So keep all this in mind. I mean, this is just stuff to remember as you go into this month. Again, lower your bar of expectations. IWF, you can kind of just look at this visually now. This is large cap growth. And you can see the last day of July, we opened near the 450 level. And here we are wrapping up August between 440 and 450. So it was pretty much a flat month for the IWF, which is large cap growth. Now, if we look at large cap value after an early weakness to start August, look at what happened the rest of the month. Large cap value has been going up all month long. So we've got, again, that rotation. It's a different way to look at it. We can look at the IWF colon IWD, and we can see that rotation going lower, or you can just look at their charts. And again, you can see it. I mean, I'm looking at the IWD, which after a weak start to August has been going up and setting new highs. We go back again and look at that IWF. We started off weak. We did rally back, but really we've struggled to get back up above the July high. And so it's the tale of two different asset classes, growth versus value. And right now, value is winning. And we're going into a period in September, which historically does favor value. So here's the IWF IWD seasonal chart. Big thing to point out here. A lot of folks say, you hear the media all the time, go away in May, go away in May, go away in May. I mean, I always say, don't listen to the media. And let me just show you why you don't want to listen to the media. Look at what growth does versus value starting in May. These are by far the 4 best months of the year. If you look across here at every month, the 4 best months are the 4-month consecutive period, May, June, July, August. Folks, we just ended August, and you could see we were rolling over in the second half of August, which is typical. Another one of my historical studies that I like to follow is when we're looking at half calendar quarters. So for instance, the first half of the first quarter, which would be January 1st to February 15th, second half of the first quarter, first half of the second quarter, blah, blah, blah. My point here is that when you go back and you study a breakdown of these calendar quarters, the first half of calendar quarters typically is the strong half. Second half is the weak half. And it makes good sense if you believe in the buy on rumor, sell on news scenario, which I do. I think that's how the market operates. So you're going into earnings season in the first half of the calendar quarter, and then you have earnings for a month. Most of the companies have reported by the middle part of the quarter. So you don't have the catalyst of earnings in the second half. Earnings and interest rates, that combination is what drives the stock market. So it makes perfect sense to me. Now, take a look as we move through August. Look at September. By the way, let me just add these numbers up for you going across. May 1.5, June 1.5, that's 3. July 1.2, that's 4.2. August another 1.2, that's 5.4. 5.4% outperformance, growth versus value during these 4 months. Now, add up the other 8 months. Minus 0.6 plus 0.1 minus 0 or even minus 0.2. You add those, that's minus 0.7. Then you got January's plus 0.7. That takes you back to even. February, now we're at plus 0.1. March, 0.2. That takes you up to 0.3. And then another 0.3 in April. So you've got 0.6 outperformance of growth stocks over 8 months. They're almost flat. Growth and value is almost flat for those 8 months. Then you get into these 4 and growth explodes. So you want to go away in May? Have at it. For me, I'll just ignore the media like I always do, and I'll follow what happens on the charts and what happens in history and continue to outperform the S&P 500 by knowing those facts. All right, keep moving. So NASDAQ 100, we talked about the S&P going up on Thursday, setting a new high. The NASDAQ, which has a much higher representation of technology names, never made it. Technology has been underperforming during the month of August. And I'm going to show you more about technology in just a minute. IWM, small caps, continue to do well. This is an interest rate sensitive group. I believe that IWM is the safer bet among the major indices, unless the Fed starts issuing statements that make it look like there is no rate cut coming. If they start to flip-flop again, I call the Fed the Waffle House because that's what they've been doing now for about 7 years. They just waffle. I think that's Powell's legacy. He's the king waffler. If they start to waffle again after just talking about the fact that we might be getting a rate cut and that's on the table, that's when you would see the IWM start to underperform again. I think as long as rate cuts are on the table or we see rate cuts, I think over time, I'm not saying every single day or every week, but over time, I believe the IWM will outperform going into year end. All right, let's talk a little bit about technology. So here's technology going down, getting a 50-day test. And you can see multiple tests down around this 255 area. I view 255 to be a really key support level. We're sitting at 262. So if we're looking at September just being a, maybe it's down a little bit, kind of typical with September, I think technology holds on to support at 255. If technology loses support at 255, I think the S&P 500 has a much, much bigger chance, obviously, of moving lower and this turning into something a little bit more, perhaps, than just sideways consolidation. Maybe we do get a correction. Maybe we do get a bear market. I don't believe that's what's going to happen, but one of the first signs that you should at least start considering it would be an XLK breakdown below 255. That is a number I'd watch closely. When you look at the XLK versus the S&P 500 on a seasonality chart over the last 13 years, so again, during a secular bull market, look at, how May, June, July, and August kind of stand out as bullish months for technology. But once you get past that, September's negative, and September, we've seen technology outperform the S&P 500 only 4 of the last 12 years, 33%, meaning 8 of the last 12 years, technology's underperformed. And remember, we've been in a secular bull market during this whole period. So clearly there's something about September historically where the money tends to rotate away from some of these growth areas, including technology. So that's some of the things we should be thinking about as we move into September this year. Couple sentiment charts I just wanted to point out. I'm looking at the 5-day moving average here of the equity only put call ratio. When it's down below 0.55, to me, it means the market's just a little complacent, could be a little toppy, perhaps, for the market. And when the fear starts to really ramp up, which sometimes we do see happen in September and maybe even early October, what I would be looking for is a move in this 5-day moving average up closer to 0.75 or higher. We're sitting at 0.59 right now. So I just feel like sentiment is kind of neutral. And it feels a little bit like that in terms of the VIX as well. Volatility index did move up on Friday because of the weakness. Prior to that, though, it was trading below 15, down near a 52-week low, not quite all the way down to a 52-week low. Got a little bit more downside action, but certainly the lowest level we had seen in 2025 last week at its low on the VIX. So that's telling us things are a little bit more complacent. But every time the market's been going up, the VIX has been going down. I view that to be bullish. What I get nervous about is when the market's going up and the VIX starts going up with it. Because as the market's going up, it tells us that we're getting a little bit more fearful, and market makers are starting to price options higher. And when they do that, that's telling us that they're expecting volatility to pick up. And volatility picking up is almost always associated with prices declining. So again, I look at sentiment. I'm not very bearish. Doesn't mean things can't turn. Like I said, we could see that 5-day equity only put call ratio shoot up into 0.7 territory. Might happen. I don't know. We'll have to kind of monitor the action in September as we go. We certainly could see the VIX spike. Many times they'll spike out of nowhere, and this is the month historically where we do see the VIX spike. Let me show you on a seasonal chart what this looks like. So if we take the VIX, you can see that over the last 5 years, remember I showed you that the S&P 500 had gone down 4 of the last 5 years. Well, when the market's going down, fear goes up. Look at the average VIX move. The last 5 years, even last year, when the S&P 500 went up 2%, the VIX went up. So we've gone up every year on the VIX for the last 5 years. If we go stretch this back 13 years, during the secular bull market, the VIX, August and September, and even into October, this is the weak time of the year historically, and that's when the VIX historically goes up. So that's why I'm saying when you look at the VIX chart, I wouldn't be surprised during September to see a spike, maybe as high as 20. I just think that's kind of a normal thing. I mean, last year we had a little bit of a weak period at the beginning of the month. S&P went down early September, and you can see that VIX spike. So certainly could happen again. For those of you that are new to Earnings Beats, if you like our approach to the market, you've been following us here on YouTube, certainly hit that like button, subscribe to our channel, but also go over to earningsbeats.com, scroll down. We have a completely free newsletter. You can subscribe, no credit card required. Name and an email address is all it takes. I've got a chart I'm going to be showing on Monday morning, a company that we'll see how it goes. I think it's at a really key pivot point. And whether or not we get the breakout to start September to kind of reverse a recent trend, I think that's going to tell a lot about the stock. But anyway, that's a stock I'm going to focus on Monday. If you are an Earnings Beats Digest subscriber, again, it's free. I'll ship that stock out to you tomorrow. Simply go to our website, name, email address, hit that subscribe button, join tens of thousands of folks that have joined us on that newsletter. Let's keep going. We're almost done here. So I want to show you the KRE. This is one position that I've continued to hang on to simply because I like the regional banks in a lower interest rate environment. When I was in public accounting, I was in public accounting for 20 years, and I audited banks. So I'm pretty familiar with banks, how they work, what makes them tick. I audited small banks, so I particularly know a lot about small banks. And when the Fed funds rate's coming down, it makes it very easy for smaller banks to gain access to capital much, much cheaper. So that's kind of on the expense side of their ledger, what they have to pay for Fed funds and so forth. And then on the other side, when rates are coming down, that typically spurs the economy, and many more small and mid-sized companies want to borrow to grow their businesses, and it becomes cheaper for them to borrow to grow their businesses. So now all of a sudden, these smaller banks, which are borrowing at cheaper costs, are now able to lend out more to small and mid-sized companies, increasing their net interest margins. And that's the driver of a bank, net interest margin. What they're collecting in interest versus what they're paying in interest. That's a big deal. And also when the economy strengthens, you have less loan losses. So that whole combination tends to spur areas like regional banks. So you can see the group breaking out. In August, I see a very nice uptrend in play here. And while pullback is, going to happen, it's kind of normal. I think we're going to continue to see this trend higher, go up and test and ultimately break out above the November high from last year, which is up at 69. So I think this is a good one of a pretty solid ways to play the market into year end. But again, like with the IWM, if the Fed turns again and starts talking more hawkishly or surprises the market and does not cut rates in September, stocks or ETFs like KRE, IWM, they're going to get hit. I believe the Fed should stay the course of cutting rates, which I think benefits these areas. But that's the potential downside, is if the Fed flips again. Another area, home construction, you can see clearly this is a group that's been trending up, because anytime you're expecting lower rates and lower inflation expectations, the thing is with home construction stocks, people think, oh, if the Fed's cutting rates, mortgage rates are going to drop. That's not how the market works. Fed funds rate is not tied to the mortgage market. Mortgage market moves more in line with like the 10-year treasury yield, longer term end of the yield curve. So what moves the 10-year treasury yield more would be lowering inflation expectations. A lot of folks once, for whatever reason, if you feel like inflation is not going to be an issue, you will want to be in bonds. You'll go buy bonds. You'll buy back into bonds that you sold previously. When you buy back into bonds, treasury prices go up, treasury yields go down always that 100% inverse correlation there. So as inflation expectations are tempered and start to come down, so too will the 10-year Treasury yield, which is what I expect into year end and in 2026. So I do think mortgage rates are going to continue to come down. We're not going back down to where we were. If you're holding out waiting for a 2.5% mortgage, I think you'll probably be waiting a generation or two, personally. But I do think we might see rates drop another 0.5 to 1%, something like that. Wouldn't surprise me at all. I mean, so for me, where rates are right now, I've certainly seen rates a lot higher. It wouldn't stop me from buying a house if I wanted to buy a house, with the thought that I can always refi if rates go back down, in another few months or even 6 to 12 months. Get it down another 1% or so probably makes sense to refi. Let's see what else. Oh, transport. So this is I talked about earlier. See, transports haven't gone back up and broken out like home construction and like the KRE regional banks. And so this is the head scratcher for me because lower rates should spur buying in transports. And some of the areas, some of the transports still are struggling to keep up with the S&P 500 and in some parts failing to do so, even though they're interest rate sensitive and they should start to go up with lower rates. So I'm waiting to see if we get that breakout above about 16.5 on the transports. In the meantime, I think some of the other ways I've talked about are probably better ways to play this group. A couple of stocks I wanted to mention real quick. I actually wrote an article over stock charts. You can check that out, but it was essentially on salesforce.com. I keep for our members what I call a key manipulation spreadsheet. And we have about 20 individual stocks on there, along with the QQQ, the Spider, and the IWM. And what I'm essentially doing right now is I'm just doing a lot of research, and I'm sharing that research with our members. But I'm looking at intraday action. It helped me to call Netflix before Netflix recently made that huge run from about 850 to 1300. It was starting to show a lot of accumulation intraday before the move was made. Same was true for Tesla before Tesla made its last huge move to the upside. I think went back up above 400 or whatever. I'm starting to see a little bit, not to the same degree, but I'm starting to see a little bit of that with Salesforce.com. And so I wrote this article because if you look at the, if you're just looking at the chart, let me just show you a few things here. But you can kind of see there's a channel line or a trend line right there. And then more recently, we've had a lot of support that came in at about 258. See all these lows right in here? All holding at about that 258 level before we finally broke down on increasing volume. And now we've come back up, and here we are back at 250, close to this 258 level, which also coincides if you connect the highs. So we've got that. We've also got this PPO center line test, which we keep failing at. We also have RSI 60 approaching. We're at RSI 57. And if you followed me, you know that during downtrends, normally the RSI will top off at around 60. Once you get above 60, it starts to feel more like an uptrend to me. Once the RSI gets through 60, and especially if it can get all the way up to 70. Rarely do you see a downtrend continue after an RSI moves all the way back up to 70. So anyhow, you've got RSI getting close to 60. You got the PPO getting close to the center line. You got overhead trend line resistance, overhead price resistance, all of this coming together right now. So this is a critical pivot area on the chart, in my opinion, for Salesforce.com. Now, on this push to the upside, unlike some of the other pushes to the upside, look at this move back here and look at the volume. But look at this move and look at this volume. And I want to show you one more thing. Let me get out of this. I want to show you the AD line, which is now at a 52-week high. So it's just starting to look more and more like CRM is being accumulated, but it hasn't gotten that technical breakout yet. And that's what I'm looking for. But this is a stock that could do extremely well into year end if it makes this breakout based on what I'm seeing, some of the other underlying bullish signals in the stock. So I just wanted to point that out. Another stock that kind of looks a little bit similar is Airbnb. I'm not quite as bullish on this one. This was a massive gap down right here with earnings. And then on the rally back, we've now gone all the way back to gap resistance. We still got the 50-day moving average overhead. And the move back up was on lesser volume than a move down. So I'm a little nervous, but if Airbnb can clear 132.50, then I think it starts to look a little bit more bullish. Until then, I'd be very cautious, and especially cautious if we move back down and lose the 20-day moving average. All right, I'm going to wrap up just a few other stocks. These were stocks that have been absolute huge winners in 2025, but struggled on Friday. First is Celestica, lost $17, 8% just on Friday. Now, if you've been holding it for a while, you're still okay with it, but still 18%, or excuse me, 8% is 8%, $17. $17. That's a pretty big hit on the stock. We went down, we tested the 20-day, but if this weakness continues, don't be shocked if we go back down and test this gap support again, which is down just below 175. That would represent more sideways. I would still view this as an uptrend followed by a flag. But that 170, 175, 173, somewhere in there, that level could come into play if we don't hold that 20-day moving average. CRDO, this is CRDO Technology Group. And all these, by the way, look at the AD line here on CLS. Look at CRDO, AD line, just beautiful. But the stock, after setting a new high on Thursday with the overall market, saw a pretty big drop on Friday, and we gave away the breakout level. I would see at least a 20-day test coming up here on the stock. And again, like CLS, if we fail, we've got some recent price support between 100 and 105 that I think would be very enticing from a long perspective. WLDN, this is WLDN Group. Another, look at the AD line. It's been soaring for the last 3 or 4 months. This stock has gone absolutely crazy, more than doubling in the last 3-4 months as well. And also looking to maybe sideways consolidate. Major gap support down around 100. The stock sitting at 109. If the weakness continues, don't be surprised if we maybe test that 100 level. NVIDIA came out with their earnings initially after hours, took a hit, came back in after hours. The next day it opened, tried to move up to a new high, failed on Thursday. So we were unable to make that new high. And then Friday, another day of weakness, or another stock that was struggling. That's had such a good year. More so a great period off of the April low, going from 80 to 180. So well above 100% return off of that August low. And look at the AD line here. Another one that I think sideways consolidation is possible. I could see, again, September, if it's weak, I could easily see a move back down to this gap support level around 164, 165. I'd be looking for that. And finally, I'm going to end this all with eBay. eBay was down on Friday, but it just continued weakness that it's seen over the last week or two. But gap support from earnings is right around 88. This one's getting a lot closer. I'd really like to see eBay turn at that $88 level. All right, that is it for me. I appreciate everybody tuning in. Got a lot to look forward to again this week, starting September. Of course, we got the jobs report coming up on Friday. We've got a Fed meeting in just a couple of weeks. We'll see whether or not the Fed is ready to cut. But watch the interest rate sensitive stocks to see how they continue to trade. That'll give you a good sense of what the market is anticipating from the Fed. And then also let's watch these growth stocks. They've been taking it on the chin of late. If they could somehow start to regain strength, that would be a great bullish signal for the market. If not, then it's one of two things. It's either the start of a possible bear market. Hey, I don't think so. I don't believe that's going to be the case, but it's certainly possible. Or maybe it's just your typical 3, 4, 5% September to the downside. That's very, very possible as well. So again, the theme for me, lower your bar of expectations as we go into the historically weak month of September. Have a great week, everybody, and I'll see you next week. Happy trading.